In September, Melbourne's property market continued its expected decline, while Sydney's property market is flat. The three mid-sized cities, Brisbane, Adelaide, and Perth, are still in the booming cycle, although the trend is slowing. Nationwide, Australia is seeing further easing of inflationary pressure. Coupled with strong employment numbers, this could further delay the interest rate cuts. Some economists are even predicting that rate cuts may be pushed back until after March next year. Meanwhile, China's significant market stimulus has unexpectedly boosted housing prices in one Australian city, which may sustain its upward momentum for a longer period during this cycle. In this episode, we'll dive into the trends of Australia's property market in September. With the overall housing market gradually losing steam, should you buy, sell, or hold onto your cash? Hi, I'm Alex. Welcome to Oz Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Let's first take a look at the housing market trends in Australia for September 2024. The national property market grew by 0.4% in September, marking the 20th month of growth during this cycle. However, the pace of increase has slowed significantly, and the market has now entered a flat phase. Sydney also saw 20 months of growth, but the growth rate in September slowed to 0.2%, down 0.1% from October. Over the past 11 months, Sydney's property prices have seen minimal growth, with monthly increases remaining under 0.5%, indicating a flat market. The slight stagnation of Sydney's market in September is a bit unusual, especially since September and October are typically peak seasons for buying and selling, a fact that is clearly reflected in the clearance rates, which I'll cover shortly. Now let's turn to Melbourne. In September, Melbourne's market fell by 0.1%, a slight improvement from the 0.2% decline in August, hinting at a potential recovery. However, for the past 15 months, Melbourne's property prices have fluctuated within the narrow range of plus-minus 0.5%, indicating a flat market. Brisbane saw its 19th month of growth with a 0.9% increase in September, though the upward trend has eased. Adelaide experienced a 1.3% increase, with the slowdown in growth being more evident compared to 3 to 4 months ago. Perth saw a 1.6% rise in September, marking the first slowdown after 5 months of maintaining a 2% monthly growth rate, bringing it in line with the pace seen October last year. After such sustained rapid growth, those who invested in Perth should be feeling excited. Our Vision members who followed our advice and purchased in Brisbane or Perth over the past 12 to 18 months have already seen an average profit of $150,000 to $250,000. Australia's property market can be divided into three main cycles. Major cities like Sydney and Melbourne are in the flat phase. Mid-sized cities including Brisbane, Perth, and Adelaide are in the growth phase, though the trend is slowing. Smaller cities such as Canberra, Hobart, and Darwin remain in the flat phase with no significant market activity. The interest rate is currently at the highest point in 4 years, and while some commercial banks have begun lowering rates, these reductions are generally targeted at new customers, with most of the discounted product being fixed-rate loans. One issue with the Australian banking system is that long-term customers are often overlooked. The longer you stay with the same bank, the less favorable the conditions you receive. This is mainly because mortgage managers are typically rotated every 2 years. Once you've moved on, no one takes care of the existing customers. The best rates and loan conditions are reserved for attracting new customers unless you are a major client like a corporate or high net worth individual with a dedicated manager. Otherwise, switching banks every 2 to 3 years or negotiating a better rate is something you must do. At Oz Property Strategy, our Vision members have a dedicated mortgage strategist who reviews their loans every 1 to 2 years, helping them refinance or secure better rates without any hassle. For those who aren't members, be sure to contact your mortgage broker or bank manager, as they will only offer a rate cut if you ask. At the end of September, the clearance rate for second-hand properties continued to align with the broader national trend, dropping from 70% 4 months ago to 60%. Sydney, Melbourne, and Brisbane all followed a similar pattern, indicating that buyers and sellers are struggling to come to an agreement. Either sellers are asking too much, or buyers simply don't have the money. That wraps up the monthly trends for each city's property market. If you want to get a better understanding of market trends, the best approach is to look at the 90-day moving average, as a longer time frame smooths out the fluctuations and gives a clearer view of the trends. From the 90-day charts, it's evident that mid-sized cities are still in a growth phase, though the trend is slowing. Sydney's market is growing but is close to flattening, while Melbourne's market is declining, though showing signs of a potential rebound. The 4 green circles in the chart represent my predictions about the market's overall direction over the past 3 years. So far, they've all been accurate, and we are in the process of verifying our 5th prediction. In September, the national rental market trend remained consistent with August, showing growth across all cities and property types. However, only Hobart and Darwin saw an acceleration in rental increases, while the upward trend in other cities slowed down. The rental yield, which is calculated as the annual gross rental income divided by the property price, remains lowest in Sydney at just 3%. This is because despite high rents, property prices in Sydney are disproportionately higher, and in recent months, some apartments have experienced vacancies and rent reductions, further lowering rental returns. Darwin, on the other hand, has the highest rental yield in Australia at 6.8%. It's important to note that this ratio reflects gross rent, meaning it's a gross rental yield. After deducting holding costs such as interest, property management fees, land taxes, council fees, water rates, and strata fees, most properties in Australian cities currently have negative cash flow due to the high interest rates. Even if the property is fully paid in cash after subtracting these costs, the net return is only about 1.5 to 3%. If the property also doesn't appreciate over time, you might be better off placing your money in a fixed interest deposit account. We've previously calculated that in Australia, investing in a property without leveraging may not be as advantageous as investing in other assets. However, once leverage is applied, and the property performs well, the long-term return and stability far outshine other asset classes. In September, the number of properties listed for sale increased by 3.2% compared to 1 year ago and was 8.8% higher than the 5-year average. The national auction clearance rate was 4% lower than the 10-year average, and private sales were taking longer to complete. Over the past year, low-end property prices rose by 12.4%, while high-end properties only saw a 3.8% increase. In some areas, apartment price growth outpaced that of houses. Looking at month-on-month rental changes, rents in Sydney, Brisbane, and Canberra experienced slight declines, while rents in Melbourne and Perth continued to rise. Overall, the national rental growth for the quarter was just 0.1%, the slowest increase in 4 years, mainly due to the 19% decline in international migration and student numbers over the past year. I believe that the national housing market will continue to rise in the short term, but at a slower pace. The price trends across different cities will become more divergent. We've also observed that Australians' ability to afford homes is likely to improve, driven by factors such as potential interest rate cuts, lower inflation leading to real wage increases, and consumer confidence bolstered by a strong labor market. With the labor shortages reducing builder profits and limiting new housing supply, the number of completed homes will remain constrained, further supporting price growth. In August, all measures of inflation in Australia showed a slowdown, with the Reserve Bank's key metric, the trimmed mean CPI, dropping from 3.8% in July to 3.4%. This is a significant reduction. So does this mean inflationary pressure is nearly gone? If you take a closer look at the individual components of inflation, your perspective might change. The main factors driving inflation down in August were a 17.9% decrease in electricity prices and a 7.6% drop in fuel prices. Most of the reduction in electricity costs can be attributed to federal and state government subsidies, which are set to expire in June 2025. Once these subsidies end, electricity prices are likely to surge. These subsidies are essentially government spending, which can still drive inflation in the long term. The current inflation drop is due to the fact that the money saved on electricity and fuel hasn't yet fully circulated back into the economy, but we will likely see its effects in a few months. If I were the central bank governor, I might exclude all government subsidy programs from inflation metrics before making a decision. Regarding fuel prices, while the inflation data reflects the situation in August, we have all probably noticed that fuel prices have bounced back in recent weeks. This is due to reduced oil production and tensions between Israel and Iran, which have caused concerns about future oil supply. Therefore, we can expect inflation figures for September and October to rise. In August, the unemployment rate in Australia remained steady. With inflationary pressures persisting and employment stable, the Reserve Bank has little urgency to cut rates. According to a survey by the Australian Financial Review of 38 economists from the banking and financial sectors, the consensus is that the first 0.25% rate cut is now expected to be delayed until March or April next year. On September 25th, the Reserve Bank of Australia decided to keep interest rates unchanged, and its next meeting on November the 5th is also likely to result in no change. Meanwhile, in the US, after announcing a 50 basis point rate cut, the core PCE inflation data for August showed a slight increase from 2.6% to 2.68%. Unemployment in September also dropped, surpassing expectations, reaching 4.1%. With these factors combined, The market now predicts that the US may only cut rates by 0.25% over the remaining month of 2024, half of what was previously anticipated. Major Western economies have already entered a rate-cutting cycle, but Australia remains on hold. Historically, Australia's rate decisions, whether hikes or cuts, have lagged behind the US by 3 to 6 months, and this time seems to follow the same pattern. About a month ago in our monthly live stream, someone asked whether the drop in iron ore prices to $90 per ton would affect the Perth housing market. At the time, I mentioned that there would be some impact, but there's no need to worry unless iron ore prices fall below $70 per ton. As of October the 5th, international iron ore prices have surged to nearly $110 per ton, making a complete 180-degree reversal. This turnaround was triggered by China's unprecedented stimulus package announced at the end of September, which aims to boost the stock market, stabilize the housing market, and stimulate construction, much of which requires steel, the majority of which is sourced from Australia. And this links the Australian economy, Perth economy, and its property market to China's policy. Long-term viewers of our channel might recall that my stance has been that Western Australia's economy has already been diversifying away from iron ore reliance for some time, and the influence of iron ore price fluctuations on WA's economy is gradually diminishing. At the beginning of this episode, I talked about when it would be a good time to buy a property in Melbourne. We've discussed this in previous episodes, but for your convenience, I'll summarize it again. The first situation is if you're buying a home to live in, and now is a great time, as property prices are low and owner-occupied homes won't be affected by the tax increases in Victoria over the past 2 years. The second situation is for those who aren't in a rush for capital gains and are willing to wait. Investing in Melbourne property is a good option. As a major city, Melbourne's property prices are the third lowest in Australia, which is unusual given its potential. Now is a prime opportunity to buy in, but many people are hesitant due to Melbourne's high taxes, low cash flow, and limited short-term price growth expectations. However, if you can find an investment property with high rental yields, ideally one where short-term rentals can generate positive cash flow, then you can hold on to the property without any financial pressure and simply wait for Melbourne's property market to rebound. The Melbourne market has enormous potential, it just needs some time. Can you invest in properties in other cities? Absolutely. The current upward trend in the market is slowing, but how can you predict how much prices will rise by the end of this cycle? Suppose Perth property prices are currently rising by 1.6% per month, with the growth trend slowing. If over the next 6 months it enters an adjustment phase, but during those 6 months, price rise another 8 to 10%, would you want to miss out on that? After the adjustment period, we'll likely hit a rate cutting cycle. If that adjustment phase lasts only 3 to 6 months, followed by another upward phase, when would you prefer to buy? Now, in 6 months, or 12 months from now? What I want to say is, 1, no one knows for sure whether a city's property prices will rise or fall in a few months or years. 2, most people follow the headlines and can't really understand the market, let alone time it perfectly. Of course, there are very smart people who can hit the right timing in every city, but I know I'm not one of them. I can grasp the trends but can't always pinpoint the exact timing. For most regular people, what matters isn't when you enter the market, but how long you stay in it. Based on that, if you're lucky, you can make a little extra, and if not, you'll still earn something, but you'll always be making money. Compared to chasing faster profits with higher risks, I prefer making steady, long-term gains and consistently earning over time. As long as you have long-term financial goals, are in line with the current market, and avoid bad investments, it's a good time to buy. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye.